Hey there, thanks for tuning in. Welcome to Investing in Germany. And today I want to talk about the savings plan that I've created for my family account. 2 months back, I did create an savings plan strategy with the ETF wherein I propose to go for a 40% investment into the emerging economy and 60% towards the developed economy like the Europe, America, Japan, and so on. And this was all based on the data that was available on the economy at that time. And since then, I don't think there has been a lot of changes to the economy. We are still in a high inflation environment. We are still going into the high interest rate environment, and we are also still on the brink of recession. So people are now discussing whether it's going to be a hard landing or soft landing. And there are also some economists predicting that we are going into a stagflation, which is really rare to see in an economy, and we are also going in that direction. So all in all, the economy is still has not recovered, has not healed at the moment due to all the money printing activities that was done since the last decade or so. And now, yeah, it's time for the economy to heal and come to its normal. And I think this is going to be the really time for us as an investor, especially as a value investor, to keep investing into the economy at the moment, into the stock market, and then get a lot of wealth creation over the period of time. So what I've created for my ETF strategy that I presented 2 months back is 40% into the emerging and then 60% developed economy. I also proposed how you can go ahead and invest this strategy from an ETF that is available in the Germany economy. And today I want to share how I have translated that strategy into my savings plan. So I have not taken the one-to-one approach what I had presented in my earlier strategy video. So let's quickly go into it. So what you see now is the scalable capital account which I have for my family account. Where I want to go ahead and show you guys. So in overall, I have three different securities here for the savings plan. So here in this account, I do only savings plan. I don't do an individual stock trading. Individual stock trading is then done in my account, in my private account. And here this account is just for the long term, very long term perspective of investing. And I call it as a family account. So as you can see here, I still have my emerging market account invested here, and I have a savings plan for 351 euros. And then you can see here also the developed economy, the Europe 600, which is nothing but an index that tracks the top 600 European companies in Europe. So this is similar to S&P 500, which tracks the 500 top American companies. Here it tracks the top 600 companies. It's a really good exposure to the European stock market. Of course, there is also one more which tracks only the top 50 companies within the Euro area. I think it's also good, but then I want to have more diversification since it is going to be a very long period of time of investing. So I want to have a 600 stocks to be tracked for the diversification here. And then what is really interesting here that I want to share with you guys is that I replaced the MSCI World Index with the Berkshire Hathaway. MSCI World Index, it tracks mostly the American stocks. About 68 or 67% is from the American stocks. The second biggest exposure is then the Japanese stocks, about 6 to 9%. I don't have it in my head now. So what you can really understand here is that 70% is already gone in two countries, the America and Japan, and the rest are like the Germany, France, Canada, and so on, which then already gets tracked through the Euro 600. So why I really changed this or replaced the MSCI World here is because Berkshire Hathaway is also for me similar to MSCI World, because Berkshire Hathaway or Warren Buffett really prefers to go ahead and invest only or mostly into the American market. And recently, some years back, he also ventured out and invested in Japanese, really big Japanese conglomerate like Mitsui Trading Company, Mitsubishi Corporations, and Itochu, and so on. There are really big companies where he got leverage from the Japanese bank, which was really cheap. And then he invested into these companies which are giving out a dividend yield of around 3.5 or sometimes even 5%. So he's making quite a lot of money from free cash that was given to him by the Japanese banks. So here it's something like similar to MSCI World. So Berkshire Hathaway has an exposure, heavy exposure to the American market, and then some exposure to the Japanese market, and also something all over the world. So for me, it was more or less similar, and therefore I did invest directly into the Berkshire Hathaway here. And Berkshire Hathaway has also one more advantage over the MSCI world is nothing but the cash that is having in its balance sheet. In the next couple of years, I'm expecting quite a lot of company going bankrupt or going for a merger and acquisition or even asking for external funding, especially from companies like Berkshire Hathaway, which has a lot of billions in its balance sheet. We are already seeing this situation here. We have a couple of banks in America going bust and also in Switzerland. And Deutsche Bank in Germany was almost at the borderline between going bust or not. But then I believe the German government will bail out the Deutsche Bank if it really goes under. So you can see here the economy is not really that great at the moment. A lot of companies going bankrupt. The liquidity crunch is really coming into play. And then the quantitative tightening, what the ECB is now currently doing by taking 15 billion out of the market every month. So there's a lot of actions going on, which will result in a lot of company asking for more money. So this will be a really good opportunity for Berkshire Hathaway to go and invest in these businesses at a really fair, even really, really cheap. And Berkshire Hathaway has the power of getting preferential shares, which is much more juicy and much more interesting compared to the shares that we can get in the market from as a retail investor. So therefore, I invested in Berkshire Hathaway and also Warren Buffett philosophy and Charlie Munger philosophy. I think this will do really well during the downturn, and I believe in the next 5 to 6 years they will have acquired a lot of value assets, which is really, really attractive for a very long period of time. So this is what I have. What you will also see here is that I have not added the 60 and 40 percentage into emerging economy. It's more or less the same, so 300, 300 and 350. One of the main reason here is because if you look at my amount of investment into the emerging market is quite high. This is because last year when the Chinese stocks were really beaten down and they were on their knees, I thought there is quite a lot of value in the Chinese stocks, and therefore I also invested my personal money in my personal account into Alibaba, China Mobile, Prosus, Tencent, and so on, which now I exited at the right time. Also, I exited or I reduced the exposure by reducing the savings plan, but I'm not selling it. It's a really good asset, I would say. And even though I have my reservation in the Chinese economy, even though it's doing much better nowadays, but then there's a political drama that is available in the market is something that is making me really concerned. And therefore, I don't want to really have a lot of exposure to the Chinese stocks. And I think emerging market is a fairly neutral one where you can get exposure to the Chinese stocks. I think about 22 to 23% of the emerging market is tracking the Chinese stocks. So if the complete Chinese economy goes under or goes like a sanctions or so on, then it's not a lot of money that is gone for me. So it's fine, I would say. And what I really want to also share with you guys is how you want to do your savings plan. So if you look at my account here, so you see a lot of ups and a lot of downs. You can see here the market went up to 300 or something like that, and then came 2 times to my 300 minus 300, and then it's just going up and down. So this is not crashing. This is called volatility because the market, it's like an auction market. So people buy and sell quite a lot nowadays in the market because every buy and sell is just a click away. It's not taking a phone and asking for the code and then thinking over it and so on. It's just all doing very, very digital at the moment. So that's a lot of volatility in the market, which is really normal. As a savings plan, you have to really keep faith on a very long period of time and then keep investing into the securities that you have selected for the savings plan. And I am doing it even if the market goes down quite heavily. I just keep on putting in. The beauty of the savings plan is that you buy when the market is at the neutral, or you also buy when the market is at its peak, and you also buy when the market is at its bottom. So over the period of time, like 10 years or 20 years, then you will try to be closer to the median. And that is what the savings plan really brings you as an advantage. But then the idea of the savings plan here is that you have to run it for decades, like 10 years or 15 years. And the compound interest that it creates really comes into effect only after 10 years. So minimum 10 years is necessary for you guys to start investing into the savings plan and to get some value creation from the savings plan. You should also be really careful here because the ETF, the diversified ETF indexes like the emerging market or Stoxx 600, it's a lot of diversification. So it will not go like individual stocks going 50% up, 20% down, and like really crazy amount of volatility. That is something that you will not see in the ETF. and this is really a good part to be an investor into an ETF. And what I have done here is also that I have tried to compensate the high inflation environment, what we are currently seeing in the euro area, with the help of this tool that is available within the Scalable Capital. So if you go here and set up your savings plan, you will see here the inflation adjustment. So here I have set it to 8% per annum, because when I started this savings plan, the interest or the inflation was around 8%. So I just put in 8% here, which it means that my monthly savings just keeps on increasing month on month up to 8% per annum. So which will give me an advantage of going together with the inflation, so that I'm not really under investing to gain the wealth creation for the long period of time. So this is what it is. I would highly recommend you to have a look at this inflation and passing or inflation adjustment. It should really help you in creating this habit of increasing your investment quota every month or every year without you really going ahead and doing it. So you don't have to really think over it and so on. Just put it as set it as a system, and then the system automation really takes care that you are investing right amount in the right time. So this is what I want to share now. And how long am I going to be in my savings plan is quite difficult to explain, but then I would say for now I don't expect to change the savings plan for this year, because I don't see market is going to, or the economy is going to recover or heal very soon, and at least until the end of 2025 I am expecting to have high inflation environment, and therefore I would really do this savings plan for next couple of years, and then maybe after that I will check if I really need to increase my exposure to the American stocks, to MSCI World or not, is something that I will just explore when the market is healed, let's say. So thanks for watching. Do comment, subscribe, and give me comments on what you think about my savings plan portfolio here into the comments, and I will try to answer all your questions and comments. Thank you very much. See you in the next video.